Today's event examines the power of market-creating innovations in development. All of us recognize the problems of persistent poverty experienced by nations, and we have tried a succession of development models based on central strategies, only to see poverty in many countries increase rather than abate. What if there was a way, instead of relying on top-down solutions, to harness the natural entrepreneurship of people to fuel innovation that doesn't only create companies, but makes entire markets? That is the thesis that our guest today, Efosa Ojomo, promises in the book, The Prosperity Paradox, that he co-authored. So, Efosa is a fellow at the Christensen Institute on Disruptive Innovation and a senior research fellow at Harvard Business School. Efosa, many thanks for joining us today.
Hi, Colin. It's my pleasure to be here. It's good to, I can't see all of you, but it's good to know you're here with us. Hope you're keeping safe.
Thanks. So, Efosa, you lead research on global prosperity at the Christensen Institute. And I wanted just to start things off, if you would tell us a bit about your work there and why market-creating innovation is relevant for developing economies.
Yeah, thanks, Colin. I think the first thing I'll share is a story of how I even began to do this work. I'm originally from Nigeria and was fortunate to come to the US to study in 2000. But in 2008, I began reading books on poverty, economics, development, and it gripped me like nothing had ever gripped me before. And I wanted to do something about it. And perhaps there are people in the audience this has happened to. And so what did I do? I started a nonprofit organization. That is sort of the dominant strategy on helping people in middle, low income countries. I started a nonprofit and went into poor communities and built wells and did some education investment, things like that. But it turns out all the wells we built, Colin, broke. And I could not somehow come back to the US, ask money from friends, like raise tens of thousands of dollars and go into communities and build wells, knowing that they were ultimately going to break in 6 to 9 months. That's when it occurred to me that there is something fundamentally wrong with that strategy, or at least incomplete, because that strategy, right, of providing a resource to a poor community, a much needed resource, is really the microcosm of the entire development industry, or at least much of it, perhaps not the entire thing, but much of it. It's this notion of let's go to a poor region, see what they lack, whether it's education, we build schools, healthcare, we build hospitals, infrastructure, we build roads, water, we build wells, without really appreciating the critical mechanism at the core that keeps those things sustainable. After that happened to me several times, failing really, I decided to go to business school, and that's where I met Professor Christensen, who unfortunately passed away about a year ago. And his way of thinking really changed my life, the way I see the world. And my hope is that it can share some of those ideas today. And his focus was on innovation, on a certain type of innovation called market creating innovation as the critical missing piece in this development puzzle. And at the core of it, I'll explain briefly, is innovations that transform complicated and expensive products into products that are simple and affordable, so many, many more people in society can afford them. When an innovator creates a new market and that makes products more affordable, three things happen. The first is they create jobs because they need many more people to make the product, sell the product, market the product, and so on. The second is, as a result of this mechanism, it leads to profits, and those profits then provide taxes that governments and other organizations, civil society can use to improve society. And the third, which is somewhat ambiguous, nebulous, but it's this sort of cultural shift that happens that begins to value entrepreneurship, innovation, and management. And so a perfect example of this, which I believe the CDC was actually an investor, is if you think of mobile telephony across Africa as an example. I like to use Africa, not just because I'm from there, but because if it can happen in Africa, I think it can happen almost anywhere in the world. I mean, Africa is the poorest continent in terms of GDP, represents roughly 3% of global GDP, when it's about 16% of global population, and so on. But CDC invested in a company by the name of Celtel that was founded by Mo Ibrahim. 20 years ago, he wants to go and give cell phones to the average African. I mean, people said, you're crazy, this will never work. There's corruption, poverty, no infrastructure. But you fast forward to today, not only is Mo Ibrahim a billionaire, but Celtel, which became Airtel, and other companies have catalyzed and created a market for mobile phones across Africa. And now it's sort of like, oh, of course that happened. Of course the technology, the timing was right. But that's not entirely true. 20 years ago, it was really hard for him to get this off the ground. But look at the impact it has had, right? Over 100 mobile phone companies on the continent, provides millions of jobs, represents a couple $100 billion in economic value. That's the power of market creating innovations in development.
It's interesting. I mean, you take an example from Africa, but I think most of us, if we were thinking about which economies in the last maybe 20 years have really experienced the most rapid growth and also have a tradition for, creating markets and being entrepreneurial and innovative, we think of China and India. And I'm wondering, I mean, are there common factors in the experience of China and India that we can use in developing economies or in Africa?
Yeah, absolutely. I think part of why we in the book we wrote, The Prosperity Paradox, and a lot of my research, we stayed away from China is because I think many people assume China has primarily or perhaps even only prospered because the government tells everybody what to do, right? Do this, do that. And I would ask the listeners to check out a researcher, Yuan Ang. She's an economist out of University of Michigan, an expert on China, wrote two amazing books, How China Escaped the Poverty Trap and China's Gilded Age. I think it's a paradox of vast corruption and economic boom or something, right? So to check out her book. And what really happened in China is a similar mechanism happen. Yes, China does export a lot of products, but it has also figured out a way to create markets within China. And the incentives that the government has created for regional and local governments support an increase in investments, right? So as a public servant, a bureaucrat, you are incentivized for increase in investment to your region. Now, there are some issues with that, but the point is the incentive isn't necessarily to, fix schools, fix healthcare, fix all the issues, which many medium and low income countries, governments can't really fix. The incentive is to drive investment, support the private sector, and that is ultimately going to create the much needed taxes to then help fix those things. So that's a critical step that gets missed. Now, the struggle in, I think, economic research is when we say China and we say India, we look at them from the top down, right? And we say, well, China has this kind of government, India has this type of government. What did they do on a policy level, which provides some insight. But I think if we step back and look at the mechanisms, right? If we divorce what is going on the government level. Look at the mechanisms that have made certain parts of India thrive, and China, increase GDP per capita from a couple $100s to close to $10,000 over the last 40 years. That mechanism is pretty much identical. And it's this notion of making things simple and affordable so many people in the region can get access to it. And I think that's the, with our research, we want to focus on that mechanism, because once we understand the mechanism, then we can go to a country and say, okay, you don't have the population China has, but that doesn't change the mechanism. You don't have the kind of government China has, or this part of India, but that doesn't change the mechanism. How can we contextualize this mechanism to fit your region?
Okay, so let's go back then to Africa, and I mean we have in CellTel a great example, and then we have in China and India, in a sense, a library, as you say, of mechanisms that have proven successful. I mean, how do we put those together, and how do we make more market creating innovations like CellTel in Africa?
Yes. So I don't know that there's one answer or one thing.
No silver bullet.
No silver bullet. No silver bullet. I thought building a well and providing some funding for education was a silver bullet, right? I mean, I read, you read economic research and you say, oh, if you do this, it increases income by this much. But the struggle with that is, look at the pandemic. Look at what has happened over the last year. Rich countries have spent upwards of 20% of their GDP on economic stimulus. Low-income countries, which have much lower GDPs, have spent roughly 2-3%. And so if our focus remains for the next 30, 40 years on alleviating poverty, building wells, if you will, metaphorically speaking, we have to ask, is that the best we can do, right? And so to the folks listening, the question is not, does providing a well have some value in a community, literally and metaphorically speaking, for 6 months to a year, or even a couple of years? Of course it does. But we have to ask a different question. Is that the best we can do? And I don't think it is. I really don't. And so to your question about how we do this, the first is simple, but what we're doing now, talking about it, highlighting the central role innovation, private enterprise, not just any private enterprise that focuses on market creating innovation has on an economy is key. And then the second is doing the hard work of building the ecosystem. That's a lot of what we're actually doing now, in that when we published the Prosperity Paradox a couple of years ago now, January 2019, we introduced this notion of market creating innovation and the impact it can have on prosperity. And as I traveled the world pre-COVID to speak about this idea, many people reached out and said, okay, how do we do this? How do we actually actualize it in our economy? How do we estimate the size of non-consumption and so on? And so, over the last year, we've been working with a group at MIT, the Legatum Center for Development and Entrepreneurship, and we're launching a market creating innovation project, really, that comprises of, a boot camp to sort of introduce entrepreneurs and managers to these key concepts of market creating innovation and how you build them. A lot of it is based on Professor Christensen's innovation theories. And then we want to build a community of these folks, to put them in a community, provide specialized coaching that can help, again, you with what your venture or your idea, with the knowledge that simply providing knowledge is not enough. We have to build an ecosystem. So we just announced it yesterday, actually. So it's fortuitous that we're getting to talk about this today.
So that's great news and something for all of us to take away. But let me ask you to be honest and challenge us. We've got a lot of institutions like CDC in our audience today, and a lot of investors. I mean, what is it that organizations can do more of, perhaps can do differently, maybe that we should stop doing altogether?
Yeah, it's look, it's a tough one, right? In some ways, we have a development industry, right, that um, that celebrates people who build wells that we know will break, and punishes people who take risks on enterprise or innovation, or how can you sell products to poor people? How can you, like, you're exploiting them? And I think we forget that 100 years ago, many of our countries were very poor. A couple hundred years ago, I mean, exceedingly poor. So I appreciate the difficulty there. I think if folks in development, especially folks who have this the charter to invest capital, can step back and just appreciate that number one, we have an industry that prizes folks who provide resources, and not take risks. That's key. The second is understanding what the capabilities of your organization are. Right. So I'll give a quick story here. Um, there was a guy who invented digital photography. His name's Steve Sassoon. We all know, none of us know Steve. He worked at Kodak. And so Kodak invents digital photography, and they're not able to capitalize on it because their business model is based on making money off print photography. Now, the capabilities, which are made up of your resources, processes, and priorities in the development, many development organizations, are aligned with what I call conventional sort of development metrics. And it's a challenge to change those capabilities, to change the resources, processes, and priorities of your organization. And it starts, I think, with the resources, right? Who are the kinds of people you hire? Are we hiring people with an investment or entrepreneurial background? You start there. And what are the processes we have in place to make investments in middle to low income countries? What are our priorities, right? Like let's ask ourselves honest questions. If we invest $10 million over the next couple of years in this region, can we walk away knowing that we have empowered people, not just projects, not just we've built wells, literally or metaphorically, but we've empowered people, and we've built an ecosystem or a system that can outlive our investment? Now, those are more difficult questions to answer, and it's incredibly difficult to build those systems. But until we start to double down on those kinds of questions, I really think we're going to find ourselves in a similar position in 50 years. I mean, yeah, Africa is going to grow a little bit. Yeah, Bangladesh and a few other countries, they'll grow here and there. But the kind of catalytic growth we need, transformation, I don't think that's going to happen if we don't think differently about how we make investments.
Okay, great. Look, at this point, let me bring in Nikunj Jinsi. And Nikunj has over 20 years of venture capital experience in developing markets, including a stint as global head for venture capital at IFC. He currently acts as senior advisor to a range of European institutions, including, I'm happy to say, CDC, where he sits on one of our investment committees. And again, let me remind you to post your questions by using the Q&A button at the base of the screen. So Nikunj, you've been in the virtual green room here listening to Efosa. And clearly, VC investment has a critical role to play in all of this when we talk about entrepreneurs and innovation. Drawing on your experience in this space, I mean, how does Efosa's work resonate with you and the experience of investing in developing economies?
Yeah, thanks, Colin, for the introduction, and thanks, Efosa, for the very eloquent overview of your work. And a short answer to your question, Colin, absolutely, it totally is spot on the work one looks at in VC nowadays in developing markets. I think the one point people may want to understand is that venture capital in developing markets, especially in Africa, perhaps less so in markets like China, but especially in Africa, it is fundamentally different from what one sees in Silicon Valley. It is all about looking at underlying economies and trying to address problems and pain points, many of them put forward by Efosa just now, and attracting that or addressing that with technology-driven solutions that are simple in nature and form. Efosa worked with Professor Christensen, who I also had the honor of meeting a few times, and it's actually Professor Christensen who developed the term disruptive technologies, which has subsequently been, I would say, misused or overly used, not in the right context. But what it means is what Efosa explained earlier. It's providing innovation through simple technology solutions and addressing the bottom of the market and disrupting an existing sector in those markets significantly by using simple solutions that are scalable as well. And the beauty about VC is that it looks at technology that is scalable. So you don't have the well problem that Efosa has. You're looking at things that are repeatable and scalable. And the other thing that's happened specifically in Africa in the last 5 years is that digitization has come ashore, and the digitization of economies made possible through companies such as Celtel and others, tower sharing companies and so forth. But now also made possible through the access, specifically that the youth and the population has in Africa to mobile data. And the very fact that they're able to access mobile data has resulted into the fact that you see pockets of entrepreneurship come up throughout Africa to address many of the issues Efosa talks about. And I'm very hopeful, although it's going to be painful and it's going to be a long path, I'm very hopeful to develop sustainable solutions that are long-term and are as well financially profitable in the long run.
Can you give us some examples of these sort of simple, transformative, sustainable solutions that maybe ones that you've invested in?
Okay, I can give multiple examples, but I don't think we have enough time for that. But look, I think one example is perhaps in the logistics mobility space. In OECD countries and westernized countries, typically logistics and mobility makes up about 8 to 10% of GDP. In developing countries, specifically in Africa and sub-Saharan Africa, it is closer to 18 to 20%. So huge inefficiencies, as you can see, and much of it can be addressed by allowing for more information to be had. So there are companies out in Africa that are now addressing it by looking at last mile delivery as well as long haul delivery. One such example of a company we invested into in the past at IFC, and CDC also has exposure to that company, a company called Kobo 360, where Ozo and his colleagues basically took a simple concept of developing a marketplace for truckers, long-haul truckers, shippers, and clients, and making more information available on a real-time basis. And using that has created a lot more efficiencies. It's not just created more efficiencies in delivery, but it's created more income for truckers, and also created more efficiencies, for example, on in terms of greenhouse gas usage, because trucks use load delivery in a more efficient way. So that looks like a simple solution, and it is a simple solution. But as one is able to expand on that, because it is a marketplace that's driven by digital technology, everybody is able to access that. Every trucker, even the low-paid truckers have access to mobile data. This is a solution that wasn't possible 5 years ago, but it's possible now, and we're already seeing it being scaled up, not just with Kobo 360. Thank God, there are good competitors out there as well. So as a whole, that whole market sector is being lifted up. So that's one example. Another one is a company that some of you may have heard of, is Andela. And the notion there was, that, and its focus on education and job force population. The notion there is that intelligence is equally distributed around the world, but opportunities are not. And with that, Andela essentially took a very rigorous process in finding the best engineers and technical graduates in the sub-Saharan continent, and looking at to a very rigorous process, selecting engineers from who come out of some of the local colleges in Africa. Selection, when I say selection process, it's a harder selection process than get into Ivy Leagues into the US. It's less than 1% of the people get selected at the end of the day. Those who do get selected eventually get paid to actually go on a particular bootcamp training course. And once they get through that, they're actually matched with customers and customers that are typically in Europe or in the US in providing solutions and being developers and developing providing their skills, but also providing solutions for them. So it's a very sophisticated way of what used to be the outsourcing IT services model and the BPO model, using more sophistication for that and actually applying it towards African talent. So I'll leave it at that. Many more examples I could give, Colin.
Thanks a lot, Nikunj. I wonder on the back of those examples whether we can talk a little bit about scale. So in Silicon Valley venture capital, you're often talking about the famous hockey stick, that you can take a lot of risk around innovation because even though your hit rate is low, once you create a market, the market is so large, it rewards the enormous, failure risk of trying to be disruptive, trying to create innovation. In Africa, by comparison, the markets are quite small. I mean, Nigeria, the GDP of Nigeria is roughly the same size of Seattle. So I'm going to start with Efosa on this question. I mean, how do we square this? How do companies afford this market innovation where the upside may just not be big enough?
Yeah, I mean, let me answer. Clay taught me to try to answer questions with stories. In the late 1980s, a prominent consulting firm goes to AT&T and says, "Hey, AT&T goes to a prominent consulting firm and says, we want to know if we should invest in mobile phone technology. How big is the market going to be at the turn of the century?" Consulting firm does a lot of research, rigorous, the best in the world, really, and comes and says about 900,000. Market's not gonna, I mean, it's your decision. You can invest if you want, but it's roughly 1 million mobile phones. AT&T decides to hit pause because they looked at the technology at the time, the earning power, how much the mobile phones cost, who used them, and said there's not a big enough market. 2001, we had over 1 billion mobile phones in the world. Today, we have more mobile phones than we have people. And so the question is, how could AT&T, global leader, prominent consulting firm, miss it? They weren't necessarily wrong, but they were using the wrong metrics and wrong trajectory. I think to answer your question, Colin, when we look at the economy of Nigeria and we say it's about the size of Seattle, that is true. You look at the GDPs and all, that is true. You look at the earning power, disposable income of the average Nigerian does not come anywhere close to perhaps even the poorest, people of the lower income in the United States. But if we assess markets that way, then we're never really going to make progress. What we have to do is say Nigeria is in a market creation phase. It's in an entirely different phase of development than Seattle is, which means the products and services that I now have to provide for the average Nigerian customer has to look necessarily different than the average Seattleite. And so if I'm providing health insurance for the average Nigerian, they don't need a $5,000 deductible or a $10,000, $50 a month premium. You start with something much smaller because where you start is not where you end. And so a company called Microinsure took the idea of insurance to many emerging economies and now provides insurance at a pittance for people who make less than $3-4 a day. They've got upwards of 65 million customers today in Kenya, Ghana, Bangladesh, several emerging economies, and they're profitable in over 80% of the countries where they've done business. You and I know Uber is not yet profitable. And so I think we really have to appreciate the fact that we got to go into these economies thinking about the innovations and the business models differently. And also with the knowledge that where we start is not where we're going to end. Just because we're only able to provide insurance that covers up to $50 or $100 if someone's market stall gets burned today, doesn't mean that's where we're going to be 10 years from now, right? But it gives us access to create that market. And that's a lot of what we're really trying to do with our research and with an event like this.
So thanks, Efosa. Nikunj, from an investor's point of view, how do you struggle with this?
Yes and no. I think exactly to what Efosa was saying, the key here is to find local solutions for the local market, not looking at technology transformation or technology transfer and looking to scale down the cost of that technology. That's not going to work. There are many, many models that are very, very local for the markets. And I think one thing to add to what Efosa said is that much like India, for example, which is not a homogenous market, there are different cultures, people speak a different language out there. That's not all that different from what you have in sub-Saharan Africa. Yet India has found solutions that are truly scalable through, fintech, Paytm, for example, that is scaled up. Similarly, in Africa, people need to be banked, whether they live in Francophone Africa or in the eastern part of Africa, they need to be banked. So M-Pesa was the first one that came out with a solution that was widely accepted. Now you're finding lots more players on the fintech side that are providing solutions on the mobile wallet side, on the peer-to-peer lending side, on the SME lending side, on the credit-driven side, on the micro-insurance side. So tons of innovation happening that is locally developed, that is meant towards for the region. So I can't think of any business that I have looked at in which they set up a business plan day one that they said, well, let's look at Tanzania only, or let's look at Nigeria only. These are regional businesses day one. And as a result, you're seeing regional entrepreneurial hubs being developed in places like Lagos, in Accra, in Nairobi. These are all meant to attract regional entrepreneurs, but also develop day one regional businesses with local solutions.
Thanks, Nikunj. Okay, I think I'm going to ask one last question to both of you before we go to questions from the audience. And I always want to end up with sort of practical advice for our, for our audience. I know that we've got investors that probably represent, billions of dollars of assets under management focusing on these geographies. So what's the practical piece of advice that you would give our audience today from what we've talked about how maybe they should change their thinking about how they put capital to work in Africa and other emerging economies? I'll start with Nikunj, if I could.
Thanks, Colin. I think you referred to earlier to the Silicon Valley model, which has got a low hit rate, but once the hit rate is high, then it's stratospheric. I'd say that curve is quite different in Africa. You'd find less what people in VC parlance like to call 100 baggers or 1,000 baggers. You find less of that, but you'll find a lot less write-offs as you will, because it's such a nascent market. There are so many opportunities in these markets, and you are at the end of the day probably not taking technology risk as an investor. You are more taking local market and execution risk. So you're taking view on the talent of the local markets. And I personally am very bullish on the talent, especially the young folks coming out now that have that different mindset and wanting to make do and can do, much as Efosa tried to do a couple of years ago. I think the people coming out now have a lot of opportunities in terms of developing a market. What they need is more access to resources such as mentorship, such as workplace resources, getting access to people with digital skills, and obviously also access to funding. But I'm generally very bullish mid to long term on Africa.
And Efosa, you get the last word before we move to audience questions on this issue.
Yeah, I mean, I think one of the first things I will say to investors who steward capital is, you are a very important part of this puzzle. Dare I say, the most important. But if you're not the most important, you're second most important. So I think just knowing the role you play, and not just returning capital to your to the capital providers, but in building a country and a continent, I think is important. The second is when you look at a region, a country, a continent, you can assess it and say they don't have earning potential. It's as small as this small city. Nigeria doesn't generate as much electricity as New York, for instance. Or you can say there is vast non-consumption, which is a term we use in our book and our research, non-consumption in this region, right? If I'm able to solve that non-consumption challenge, there are going to be significant rewards. Now, I wouldn't bother myself with the solution yet. Just assess the non-consumption. That I think a lot of times we conflate the solution with the problem, and it's what AT&T and this consulting firm did 40 years ago, looking at the mobile phone market. So just appreciate the non-consumption. And then the third is, okay, are there technologies, especially digital technologies, and entrepreneurs and business models that can help us solve this problem, right? And so you appreciate your role in creating prosperity for many. You assess the non-consumption and appreciate how much of it there is. A friend of mine once told me in many emerging markets, there are low-hanging fruit, but they're just really difficult to pick, right? And so there are no technology risks and things like that, but execution risk, political risk, currency, exchange rates, and so on. Appreciate that. This is not easy for the faint of heart. And then the third is doing the hard work of finding entrepreneurs, other investors who believe what you believe, and then building new business models that can create wealth, but really give people hope. And at the end of the day, I'll end with this. That's what the professor did for me, Clay. When I left Nigeria over 20 years ago, I had no hope. It was too corrupt, it was too poor, no infrastructure, no electricity, water. And I was like, there's just no way we can become an America. Like, it's just impossible. But after doing research with, a late professor, I know it's going to be incredibly difficult, but I actually have hope. I actually drink my Kool-Aid. I believe that many emerging markets can become prosperous, but the paradigm has to shift from building wells to empowering people, and more specifically, entrepreneurs.
Okay, thanks. Well, let's move then to questions from the audience, and the first one to you, Efosa, and it really is picking up on this, and maybe you can share with us how to drink the Kool-Aid. But I mean, one of the key themes behind the prosperity paradox is this shift from a top-down approach to a more bottom-up entrepreneurial-driven approach. But you allude to some of the problems that I think most people would recognize in that, which is that you need a certain amount of ecosystem for entrepreneurial innovation to succeed. Some of that is kind of technical infrastructure. Some of it is business climate. So what's the solution for that? If you don't have the structures, how can you trigger the market building innovation?
Yes. So I think one of the challenges, right, this way of thinking will face is we don't really know like what the solution is, right? So you go to a poor community that doesn't have water, like we know what we want the outcome to be. It's water. So like build a well and boom, no matter whether it's sustainable or you can fix it, but we know that. That's why I think, nobody ever gets fired for building a well. Now there's experimentation that has to happen. We just announced the Market Creating Innovation Bootcamp. We want to educate entrepreneurs. We want to provide them with coaching, access to capital, put them in a community. Is that going to work? Well, I'm going to write about it, and perhaps it'll be the core of my next book. But we have to experiment and we have to try, right? Now, in terms of who does this and how, I think it's context specific depending on the country you are. Rwanda has a very sort of forward-thinking government, very different than Nigeria or Uganda, Kenya. So the execution will look different. But I started off by saying this mechanism. If we know that we have to figure out a way to create an ecosystem that supports a certain type of entrepreneur, if we all can agree on that, then how do we lobby the government? How do we fund this? How do we go to the DFID, which is no longer DFID, I forget what it is now, but CDC, DFID, USAID, the World Bank, and say, hey guys, fund this program because this is what we're trying to do. It's going to be a process, but until we elevate the work to a level where it demands people's interests, then I think the folks building the wells are going to keep winning.
Okay. So next question, Nikunj. I mean, in your comments, you indicated how the Silicon Valley kind of mindset doesn't really apply to developing economies. So the question is the answer here then to really build up local investors and regional investors who perhaps better understand the challenges of their markets rather than Western capital coming in to fuel these innovations?
Absolutely. And that's what I was doing at IFC, and I believe CDC is doing now as well. It's really about developing, as mentioned earlier, there's enough local talent on the ground. And we need to look at local investors at all levels, not just as providing venture capital, but also those who are able to set up the boot camps Efosa was talking about. You don't want stellar, as it's been happening in the last 2-3 years, you don't want some of the stellar local talent that have developed local good solutions end up with Y Combinator or 500 startups. Nothing wrong with those places, but they end up going to the US for getting the solutions, whereas you want to provide those resources locally. And I believe there's quite a bit of that happening already, not enough. A lot needs to happen ahead of us, but there's a good amount of these early stage mechanisms, whether it's incubators, accelerators, so forth, around places like Lagos, Nairobi, Accra, Dakar, and so forth. Many of them don't have a sustainable model, so you'll find a large mortality rate amongst both the mechanisms as well as the companies that they fund. But this is what is needed. If you look at the evolution that's happened in other successful ecosystems, you find that too. One needs to go around and find the right system that works in the local markets. And it's going to be a combination of, at the early stage level, of getting the right mentorship, angel networks, boot camp kind of solutions, augmented probably by a lot of TA and NGO facilities to help these guys be sustainable. And again, there's going to be a lot of drawbacks, but longer term, I'm convinced that there's an opportunity that people could leverage on and capitalize on. But it's got to be done locally. And I also strongly believe that local investors will be able to assess the market much better than Western investors would be.
Great, thanks. So back to Efosa. So back to Africa. The successful example that you use is one of people buying and selling mobile phones, and then the model of the failure that you use is your well. But isn't there something further here about a public good and a private good? So the wells are water, which are, along with health and education, healthcare, transportation, are generally considered to be sort of public goods. I mean, is there a way that the private sector, through market innovation, can solve these public issues, going back to your wells, rather than just buying things like telephones?
Yeah, I mean, I think if we step back, this is why I keep referring to Clay because he taught me a lot. Um, what makes water or schools or healthcare public versus private, right? We are the ones who have defined that. We've put categories on things, right? And they might help us sort of allocate national budgets, but we have to focus on the core, the mechanism or the fundamental, in the sense that what is a school? Well, it's a place, an organization or place where people go. They don't have a particular set of skills or knowledge. That school provides a product, gives them that knowledge, and they should leave and be more productive members of society. That's, whether it's public or private, that's less the issue. To operate an organization like that, you need capital, you need talent, you need, resources and processes. And that organization has to be profitable. Now, it doesn't have to be profitable in the sense that, I need this much IRR or so on, but it has to be sustainable. And so I fear sometimes when we say this is public, private, and so on, we might be letting ourselves off the hook in that, oh, this doesn't need to be profitable or sustainable. No, every single thing we create has to add more value than it takes, because if it doesn't, it's not going to be sustainable. And so once we understand that, then we can appreciate that whether it's schools, phones, food, water, why is food, for instance, not a public good, right? Why do we have food and beverage companies that are making a lot of money and we say that's private, but like, why is that not a public good? I need food more than I need schools, right? So we are the ones that have placed these labels. Once we understand that, I think it helps us be more creative. The second thing, I'll end on this, I want to get to more questions and Nick can chime in, but is behind every provision of a public good is private enterprise providing the tax dollars, right? So if we look at the United States, where the government spends close to, I think it's $10,000 per student per year, how does the United States spend that much money on education? Yeah, the government spends it, but I pay property taxes. How do I pay property taxes? Well, I bought a house. How did I buy a house? Well, I got a job. And so there is no way we can get around this notion of private enterprise creating value, whether or not that value then gets distributed by way of providing education, tax subsidies for companies, or so on. That's a different argument. But we have to appreciate the role that private enterprise that focuses, I'm biased towards market creating innovation, there are other types, does, especially in emerging economies. So I'll end on that note.
Thanks a lot. And I am trying to get through these questions by farming them out, between you. But by all means, if you want to comment on a previous one, do so. But but continuing on that theme, I'm going to go back to Nikunj. And we've got a question here, I'm sure, from an investor who says, VC is still very much an emerging investment tool in developing economies. And there's a question here about what lessons did you learn at IFC around VC investing in development that you could pass along to investors who are thinking about potentially going into that market?
Yeah, thanks. It's a very good question. And I think there are many, many lessons on it. But to summarize a few, I think you want to study successful ecosystems. So starting in VC ecosystems. So we talked about Silicon Valley. There are some that are developed outside of the Valley too. But by the way, the US by itself is not an ecosystem because 50% of the VC happens in Silicon Valley and about 35% happens in Boston, New York, and Austin. So US by itself is also deficient on VC innovation. Then perhaps look at China, which started about 20, 25 years ago, and now has a fully functioning ecosystem with proper exits, local capital markets, and so forth, and obviously had a huge market to absorb many of the solutions. I'm not sure if all of them were pushed by the government. They just had a ready middle class population that was coming out of poverty that was ready to adopt these solutions, and was combined together with the adoption of mobile phone technologies. Subsequently, you saw that happen in other pockets in Europe, France being another example where ecosystem developed. India also now has more or less a functioning ecosystem, which took a long time, by the way. And that is the key thing. You want to look at the elements of the ecosystem that are missing, and understand that it takes some time to develop. But especially the first people who go into those ecosystems, into those markets that have an inefficient ecosystem, and are actually able to identify good opportunities that actually do very, very well. So the initial investors in both in China and India who were there when the ecosystem was not working very well, did very well financially. They're still around, they're still doing okay financially, but a lot more competition. Similarly with Africa, one needs to be patient. One needs to be patient on, from an investor perspective, you will have the obligation, obviously, to pay back money with returns to your own investors. So that's why you want to be looking at exits. 5 years ago, I would say there were no VC exits in Africa. Now you're seeing them happen. Case in point, Paystack got acquired by Stripe, and that's just the beginning of several others. You had Jumia that listed on the stock exchange, and there will be more such examples coming out. And that is just, you're taking the blueprint, the pattern, what's happened in other ecosystems, and you're seeing that happen here. So what I want to emphasize again is that, some people think that doing VC in Africa is risk on risk, and I would disagree with that, because you're not taking the traditional technology risk. You are taking underlying market risk, and yes, there will be policy and forex issues in addition to that, but you're taking underlying market risks. So if you're able to take a view on the underlying market, the mid to long-term development of the underlying market, and you are able to assess particular management teams, then I think there's actually a very fruitful and very commercially viable space in Africa. And you're seeing, again, in contrast to 5-6 years ago, now there are at least a dozen VC firms now that have $50 to $100 million assets under management. And I know of at least 50 VC firms probably that are fundraising to raise the next fund. So this is development that is all part of the early stage ecosystem building that I'm happy to see happen.
Great. Okay, last question, and to Efosa before we sum up here. So, I think you've laid down a clear challenge for development finance institutions like CDC, IFC, the new DFC in the United States. But what's the role of traditional development organizations? And you alluded to them, DFID, which is now, by the way, part of FCDO, USAID, the World Bank, and others. How do they fit into this new model of bottom-up market disruption, private sector led?
There's the question of how I would love them to fit in, and how they fit in. To understand anything, we have to go back to the history. If we look at the history of development, 1949, Harry Truman gave his inaugural speech called the 4 Points Speech. And the fourth point he made was on, essentially gave birth to the development industry as we know it today. And he talked about the US looking at poorer parts of the world and providing resources for them. And shortly after the creation of Technical Corporation of America, TCA, I believe, and then that morphed into USAID. And I think that idea that we have, they don't, let's provide, let's help, let's give them the resource, is still dominant in the industry today. Now, no country has ever developed in isolation, right? In the development of America, we needed capital from and talent from Europe and technology, really. You look at Japan, took from the US, look at Korea, took from Japan, China, it's taken from everybody in a sense. And so no country develops in isolation. But I think the development players, conventional development players, can appreciate the mechanism by which we can create sustainable development and do more research in that, can support more programs, right, that focus on empowering innovation and entrepreneurs, can focus on specific contextual policy, not sort of this country is at this institutional level in this global ranking. That doesn't really, I don't think, help as much, but it's like, okay, you're in this sector, you want to go into this country, let's understand what we need to do in that context, right? I think if the conventional development players can support that kind of research, that kind of work, publish that kind of stuff, then the finance, the DFIs can become more successful. But if we continue to fund research that says, I gave 1,000 people in this Tanzanian village $50 a month, and I studied them for 2-3 years, and their income, their lifestyle got a little better. I mean, is that really what's going to help a country? Let's be honest. Again, not that doesn't have impact in some way, but we want to transform lives, right? We want people to be prosperous, to have hope. And I think the USAIDs and FCDOs, they can support research, provide some backstop financing for these types of ecosystem development.
Okay, thank you very much, Efosa and Nikunj. Let me see if I can sort of summarize this very broad ranging conversation we've had today. But if I would create a synopsis of what Efosa has said today, what he's asking us to do is shift from individual efforts by, as he describes it, looking at a well, to instead building ecosystems and markets. And that's the only place where we're going to generate true transformation and see the catalytic impact and economic growth that we need in these economies. So then we spoke a little bit about how we do that. And this is where Nikunj gave us some great guidance and simple technology solutions that can scale quickly. And Nikunj gave us some examples, spoke to us about how we could get into the venture capital industry and the benefits and the pitfalls of it. I was really struck by the pragmatic and the practical solutions that we need, both on the side of investment and capital and on the side of entrepreneurs. And it was great to hear from Efosa about the Market Innovation Project at MIT, which is really trying to introduce entrepreneurs to practical solutions about how to create these innovations. But for me, if I'm going to finish on only one theme, it was Efosa's plea for us to at least be honest with ourselves about what it is that we are trying to do in development, and to genuinely assess what the success and, in honesty, the failures of what we have been doing in the past and today. And that's a great challenge for all of us to take away from that. So that would let me finish off by thanking both of our speakers. One of the detriments of COVID is that you don't get the benefit of hearing a long and sustained round of applause from our audience, but trust me, it's there. For our audience, thank you very much for joining us. Join us for our next Insight event, where I believe that we'll be speaking with Sir Ronald Cohen about his experience in the emerging sector of impact investing. So until then, Efosa, Nikunj, and all of you, thank you very much.
Thank you.
Thank you. Thanks for hosting too, Colin.
Thank you, Colin.